Firstly, I use a framework that I call the everything code. It's something that I've spent 35 years building in macro, where I started to realize that the dominant factor in all of macro is actually liquidity and the debasement of currencies, and it explains most price movements in all of the assets that we care about.
Raoul Pal dives into the wild banana zone and where crypto could go next. Let's watch and explore what's coming together.
And I realized that it's all to do with debt, and it came from why we're seeing 4-year cycles in crypto, and the economy and all of these things is actually driven by the debt refi cycle. The world just reached too much debt back in 2008, and what we've been doing since then is servicing the debt. We've also got some other key factors. This chart is a chart that I produced a few years ago. It's still the single most important chart in macro and explains everything that is going on in our world today. And this is the fact that demographics is everything, and the demographics of the aging populations across the Western world, these are the US numbers using the labor force participation rate, explain the build-up in debt. Why that is as populations get older, economies slow down. To service the existing debt, it requires more debt. To create GDP growth, you need more debt. See, GDP growth is driven by population growth, productivity growth, and debt growth. And debt growth has been the driver both in the US, in China, in Europe, in the UK, all across the world. It's all driven by the same dynamic, and that's this aging population thing. It slows down GDP growth and creates unstable economies. And that chart just shows the stunning correlation between debt to GDP and population itself. What's interesting is then when you go one stage further and say, okay, we're seeing this debt, how are we dealing with this debt? And it's actually just driven by liquidity. So here I'm using Fed net liquidity. Fed net liquidity is the balance sheet of the Federal Reserve, the Treasury General Account, which is the Treasury themselves, not the Fed, and then the reverse repo facility. These are the levers that they've been using. It started just using the balance sheet, 2009, all the way through to about 2014, it was just the use of the balance sheet. Then they started sneaking in new ways of debasing currency, and that was by adding in these other levers, getting banks to put reserves here or take reserves out there, or injecting money into the economy via the checking account, the Treasury General Account. That's actually shifted to total liquidity.
Bitcoin is entering a crucial week, with markets bracing for the Federal Reserve's interest rate decision and key support levels under pressure. The price is hovering near $94,000, as traders eye the $93,500 yearly open. A strong bounce from this level could signal bullish intent, but failure to hold could bring deeper losses. At the same time, Bitcoin dominance has surged to 65%, its highest level in over 4 years, signaling a potential final push before a major shift. Analysts like Rect Capital believe dominance could climb to 71%, a level that historically marks a peak before altcoins begin to outperform. Some, however, argue this cycle is different. With major institutions like BlackRock and Strategy holding Bitcoin long-term, fewer investors are rotating into altcoins. Still, the altcoin crowd is waiting for a breakout moment as Ethereum/BTC nears levels not seen since 2019. Adding to the tension, traders are watching Fed Chair Jerome Powell's language during the upcoming FOMC meeting. Economic uncertainty, growing recession fears, and weaker GDP numbers are putting added pressure on risk assets. Meanwhile, social media sentiment is shifting, with more people calling for higher BTC prices again, a sign that FOMO could soon return. As always in crypto, all it may take is one big candle to decide what happens next.
Everyone figures out the game, which is the debasement of currency. Debase the currency, try and grow GDP growth at lower debt to GDP, or just manage it. Now they're using total liquidity, which includes measures like M2, which is the banking system as well. So when you add those things up, this has, and I'll show you these charts later, the most stunning correlation of all time to all assets. So 90% of Bitcoin's price movements are driven by total liquidity, and 97% of the NASDAQ. So here's the real issue here. Why are the rich getting richer, the poor getting poorer? Well, scarce assets keep going up in price. Real estate, equities, art, gold, all of these things. Young people can't afford it. Poor people can't afford it because they've got variable income, which is earnings, and it buys them less of these every year. What's actually happening, what that mechanism is a tax on everybody of 8% a year. A global taxation of 8% a year that you don't understand. You just don't get richer by 8% a year. Add in another 3% global inflation, you're at 11% debasement of currency. That's your hurdle rate to stay as wealthy as you are today. That's a staggeringly difficult thing, considering most asset classes don't produce those kinds of returns, which is why so many young people have come to crypto, because crypto completely upends this system. They can't buy houses, they can't buy all of the other things that older people were able to afford. So they forced into more speculative, higher risk assets that have much higher returns. It's the only way out of the trap. And the trap is driven by this debasement. So if you want to see how close the correlation is, and I'll show the full correlation chart later, it basically drives Bitcoin. And what we see is there's periods where it decouples, and these are the banana zones. It decouples when what we get is the retail frenzy and the frenzy into the market, cools off, comes back to trend rate of this debasement of 8% or so. But over time, it produces astonishing returns. And that's why Bitcoin looks like this on the log regression channel. It's also still remarkably cheap. Where it ends up at the end of the banana zone is usually the 1 or 2 standard deviation level. We're a long way from that, and that would give us much higher prices. You can't see it on this. But if it were to get to 2 standard deviations, that would put Bitcoin at $850,000. I don't think it's going to go there.
Michael Saylor and his company, Strategy, are doubling down on Bitcoin once again. For the 4th straight week, Saylor has hinted at another purchase, continuing a remarkable streak of accumulation. On April 28, Strategy added 15,355 BTC to its reserves in a deal worth over $1.4 billion. That brings its total holdings to a staggering 553,555 BTC, solidifying its position as the largest corporate holder of Bitcoin. Despite some mixed financial results in Q1 2025, with revenue down 3.6% year-over-year to $111 million, Strategy's Bitcoin-focused approach remains full speed ahead. According to Saylor Tracker, the company is currently up around 39% on its total investment, boasting more than $15 billion in unrealized gains. So far in 2025, it has acquired over 61,000 BTC and is planning to raise another $21 billion through an equity offering to keep buying. Some analysts believe Strategy could take its strategy even further. Richard Byworth suggested the company might acquire entire businesses with large cash holdings and convert that capital into Bitcoin. With Strategy now buying over 2,000 BTC per day, more than 4 times what miners produce daily, analysts like Adam Livingston believe this pressure is creating a synthetic halving effect, increasing scarcity and possibly setting the stage for Bitcoin's next big rally. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoin Zella for daily news all for free. That's all for today's video. Until next time.